Hello and welcome to Policy Bazaar. I'm Arjun Bhagat. Now, choosing the right insurance policy is perhaps one of the most important decisions we all need to make given the uncertainties of life. The life insurance policy that you choose will have critical ramifications provide for your family in case something untoward happens. A wrong insurance product can prove catastrophic to your financial health and the financial security of your family. To help choose the right product and highlight the 7 mistakes that we make while buying insurance, we have with us Yashish Dhaya. Welcome to the show, Yashish. Now, what are some of these, mistakes that we end up making? What do you think is the biggest when we buy an insurance product?
I think the biggest is one of mindset. Insurance, we've said repeatedly, is about risks. It's about what happens to the financial stability of a family if the primary earning member dies, gets disabled, has a critical illness, or anybody else in the family has a critical illness. There's a massive health scare in the family. If the family has not planned for a pension, because people do retire, and when they retire, they need to survive. And if children's costs are not planned for, and children suddenly hit university, and then you don't have funds to kind of support them for university or college or marriage or settlement, whatever that be. So those are the things that one needs to plan for in insurance. Going outside of that and thinking of insurance as some form of return-based product. For return-based products, you have fixed deposits, you have mutual funds. There are many options. You have PPFs, you have EPFs. There's lots of. So the tax implication, the tax benefit of insurance policies cannot be the reason why you start. So the starting point is incorrect. And if you start at the wrong starting point, then you end up at the wrong place. So the most important part is to make sure that it's about risk. You can have your financial planning, but to make sure the financial plan actually lives up in case a catastrophe hits the family, that is what you have insurance for. If you look at these 6 products that we spoke about, these 6 products should not leave you with much else in terms of insurance planning outside of your assets, so your car insurance, etc. But these should take care of things. I think once one gets that mindset, then the investment, which is the best plan, etc., can come next. But the first thing is to go step by step into those.
So what you're saying is look at it as risk investment rather than as a saving perspective. I mean, of course, that is a benefit. That's an added benefit, you say.
Yes.
But risk is the primary goal that you need to ward off against.
I think the moment we do that, people would know why they are buying a policy. See, if you ask, I meet lots of consumers. I meet a lot of people who buy insurance. Whenever I speak to them and I ask them, why did you buy this product? Somebody said, "Isme return acha tha." Somebody said,
right.
So no cross verification. Isme return acha tha. Most insurance products don't have a good return. They cannot have a good return. Some low cost ULIPs do, but besides that, you cannot really have a good return. So that can't be the reason for buying. And the problem is 70-80%. So let's put it this way. Pure life insurance, which is term insurance, health insurance, critical illness, personal accident. The first 4 products I spoke about do not even constitute 3% of insurance in this country.
And that's where the focus should be of any individual and family.
And that is what is fundamentally wrong. Fundamentally, we need to get that right. If you speak to most people who understand the insurance industry as, within quotes, they will usually tell you that is not how you make money in insurance. But the objective of insurance is not to make money. The objective of insurance is eventually for consumers to get insurance. So the consumers need to wake up to that. The consumers need to wake up to the fact that what they need is coverage. And once you cover those 4, which we spoke about, death, disability, critical illness, and health, then you move on to pensions, and then you move on to child cost planning, or the other way around, whichever is your priority. But the first 4 need to be covered, and they need to be at least 30-40% of your insurance cost.
Right. And now another tendency that we've seen, as far as all of us are concerned, is going for the cheapest product. So we end up buying cheap insurance, saying that, okay, I've covered this part of my life. Is that the correct perspective?
No, it is not. See, insurance is a complex product. There are lots of pieces in it. So if you take health insurance, for example, in health insurance, one company may not have room rent capping, another company may have room rent capping. One company may have a 2-year wait period for pre-existing disease, another may have 4 years wait period. One may have some permanent exclusions, one may not have permanent exclusions. One may have copay. Copay means you will have to pay 20% of the cost. One may not have copay. So there'll be lots of reasons. One may have a cover enhancement, one way. So basically, you start off with a 5 lakh cover. After 5 years, if you have not made a claim, it automatically goes to 10 lakhs, 20 lakhs. In certain cases, you can increase it up to 50 lakhs, obviously by paying a slight extra premium in that particular situation. So does it work with inflation? Does it adjust to inflation? Now, when you put all these factors together, it cannot be a price decision. It cannot be that, okay, I'm getting this policy for 3,000, that policy is 6,000, so this one is better. No, you have to weigh the features, and this is not a product you can buy blindly. You cannot, you have to get engaged. And see, if you don't get engaged, then you have only yourself to blame, because nobody else has an interest in kind of educating you.
Right.
Eventually you've got to make the purchase, and you've got to be involved.
That actually brings me to my next question, that there are a lot of influences or influences that motivate us to buy a certain product, whether it is an insurance agent, whether it's commercials. We see a lot of them. So we are being pushed in a certain direction. So your point about making sure that you do your due diligence is very, very important. But how do you avoid that mistake of getting under the influence of a certain person or a certain commercial and saying, okay, I'm going to buy this. This seems really slick and good.
I think, see, one thing is getting into the detail yourself, going onto company websites, going onto comparison sites and doing your analysis, going on to blogs and learning about products. I think the second aspect is just cross-checking, because suppose you're not capable of doing that. Suppose you say, hey, you know what, this is too complicated for me. I'm not going to go onto company websites. I'm not going to go onto comparison sites. I'm not going to do the comparison. However simple you make it for me, that's not my... Then just cross-verify. So speak to one agent, speak to another agent also, and get a view on the product that you're being pitched. What is it? Most likely the second agent will tell you the reality of because he may not be selling the same product. So they will usually tell you the reality of the product. So that is another way of kind of getting some clarity.
And also elaborate on assessing one's needs to buy a certain product, because that's, again, that falls into the same decision-making process, but you're actually evaluating your own life and the circumstances there.
We started off speaking about the 4 key products: death, disability, critical illness, and health. If you start off by saying those are my 4 primary products, now what you would find is most people would not pitch those products to you, because those are usually low-cost products. Those usually don't have very extensive distribution margin. So nobody's really interested in you buying just those products. So you will have to go and work on your own, and the proof of it will come across. The moment you speak to somebody and say, I want only these products, the person will start losing interest. Everybody would want to sell you the investment products, the
because
endowment
that's where
products,
the margins are.
Because that is where, if you spend 15,000 rupees, the person will also make some money, and his household will also continue. So be a bit wary. It's astonishing, even today in the country, 25 lakh of those endowment plans sell, but so few health insurance plans sell. Not even 20,000 term insurance, pure life insurance plans actually are bought by customers, despite the fact that they are in the same month buying 20 lakh endowment plans. So the customer does need to wake up. At the end of it, nobody can protect the customer beyond a point. The regulator cannot do more than a certain amount. The education can't do more than a certain amount. Eventually, the customer does have to wake up and take responsibility.
Right. And what about the aspect of adequate insurance? Do you think that is something which is important that we need to look at?
I think people
are we underinsured?
I think as a country we are severely underinsured, given the health insurance penetration levels. And I'm not just talking about the lower income people or the middle income people. At every stage you find underinsurance. You find less consideration about the future. So we are underplanned from a pensions perspective. We are underplanned from a life insurance perspective. We are underplanned from a health insurance perspective. We are totally unplanned from a disability and critical illness plan perspective, because those plans barely exist. We barely sell those policies in
So just elaborate on that a little bit.
So as I said, just think for a moment, what happens if the primary bread earner of the family faces death or has a severe disability because of which they cannot work any further? There are costs of the family that still need to be run. And plus, if the person is surviving, that person also needs to be taken care of. A rough rule of thumb is if the individual is between 30 to 45, a rough rule of thumb is that cost will be roughly about 10 to 15 times 1 year's income. And hence, that amount of funding needs to be prepared through life cover. Or now what that automatically means is if somebody's got a 5 lakh rupee income, they need a cover of about 70 lakh rupees, not a cover of 5 lakh rupees or 6 lakh rupees. That will be totally inadequate. So they need a cover of about 75 lakh rupees, and both for death and disability. Now, critical illness, we've all heard when critical illnesses hit people, they can shave off tens and twenties of lakhs, primarily because that's the cost of handling these diseases today. Critical illnesses being those 5, 6 really major diseases like cancer, heart disease, brain tumor, etc. So for those diseases, one has to take a cover. Then comes health insurance, the normal stuff. Somebody falls sick, somebody goes to hospital, stays in hospital for 5 days, comes out, that cost needs to be taken care of. That is what you have health insurance cover for. Now with these 4, you're basically largely covered. If you think of what's happening in the country, some people have health insurance, very few people have life insurance cover, almost nobody has significant disability cover. Disability meaning not being able to work because of disability. Almost nobody has critical illness cover. Pension planning is, some people have done a bit of it, but it's still weak. Child plans are again, so that's our situation. What we usually have is 20-year plans, and some of those questions will come every day. Right. They come every day. I give 50,000 rupees a year for 20 years. I get back 10 lakh rupees. Is that a good plan? You're giving 50,000 rupees. For 20 years, that adds up to 10 lakh rupees. So your own money is being returned to you.
So that brings me to the single entity nature of buying an insurance product and saying, okay, I bought this, as you said, 50,000 per year over 20 years. Do you think it's a standalone kind of a decision that, or one needs to keep reevaluating it?
I think, as I said, it is not a standalone decision. It keeps, so before one is married, one probably does not require term cover. But once one is married, term cover is required. Disability covers are required all the time. So one needs to evaluate, I think every 3 to 5 years, one needs to evaluate their changing needs of insurance. One needs to take it seriously, and one needs to at least start off by not considering it as investment. If you have additional funds remaining after having bought your primary insurance plans, which may be worth about 30,000-40,000 rupees, so if you have the remaining 1.5 lakh rupees left, yes, you can go ahead and kind of invest that into low-cost tulips or into short-term instruments where you can get your returns in a tax-free manner. So no doubts there, but please complete the primary insurance requirement first. So every time you buy the next policy, say, hey, I don't understand this policy, but there are 3-4 risks that I do understand. Have I bought those plans first? And once you buy them, please go ahead and then do whatever else is required.
What about the common mistake where we don't fill out our own forms? It happens in a number of instances in life. Whether you go to a bank, they say, "Yahan sign kar dijiye," just sign it here. Do you think that is okay?
No, it's certainly not okay. See, when you are investing in a bank, you are putting your money in, and you're going to get your money back. That's one piece. You ideally should not be filling out that form, but those are fairly transparent products. I know in a fixed deposit I'm going to get 8.5 or 9% returns. They're fairly transparent. Insurance is not such a transparent product. So please do to yourself 2 favors. One is read the policy details, and second is fill out your form yourself, because if you provide any wrong information, you will not get the claim. At least in the initial few years, you will not get the claim, or you might be denied the claim because of wrong information. But, the transaction would have happened. Now, the second thing, as far as insurance is concerned, a lot of people will tell you, look, you will get the policy, then you'll have 15 days to cancel it. My views don't fall for that. Ask for the document upfront. Because the point is, cancelling in those 15 days, you may get your policy 5 days late, etc., etc. So it is quite difficult. My father's tried to cancel a few policies. They don't happen that easily. When you do try it, excuses are found to let you go through the 15 days, and only then, okay, sorry, now 15 days are over, now you can't cancel it, right? So don't fall for that. basically say, no, I will check the details upfront before signing on, before signing up my money.
About non-working family members, do we not consider them or the value of what they contribute towards our households, given the insurance aspect of it?
I think one should definitely try to take a health cover. So again, let's go into the different risks we spoke about. So health and critical illness is equally important for a working member as a non-working member. So every member of the family should be equally covered under health insurance and critical illness covers. Now, when we get to death and disability, it is true that the primary income earner has higher economic value. However, the concept that somebody who's not got an income does not have any economic value is certainly not true. I know a lot of people who give up careers to manage their homes, and it's quite valuable to manage their homes. And without those people, it will be far harder for their spouse to manage the same lifestyle or manage their children in a similar manner. So there is a certain clear value to it. A rule of thumb can be half. So if the primary earning member is taking a 1 crore cover, they should try for a 50 lakh rupee cover for their spouse. There are companies that provide these covers now without any income financial underwriting. So financial underwriting means they don't need an income proof. They, as long as the primary earning member has taken a cover of 1 crore rupees, the secondary member who is non-working, their spouse, can take a cover of 50 lakhs with no requirement for them to have an income. And that is quite unique that the companies have done, primarily because they value the view of the family.
Right, Yashish, well, it's time for your questions now. We've got Kumar Singh from Jharkhand. He's 30 years old and he says, I came to know about Religare I Maximize plan through Policy Bazaar. I've been told that if I pay 25,000 per annum, I'll get 11 lakhs approximately after 15 years. Is it true, he asks, Yashish?
See, first of all, iMax, this you would have been told a while ago, because iMaximize is not a valid plan for the last few months, so it's out of circulation. However, it is a very good plan. It was a low-cost ULIP. The alternate plan you have today is an iGrowth from Aviva, which has got fairly low costs. There is another one from HDFC called Click to Invest, which is also fairly low cost. And I think, see, if you look at the markets over the last 30-35 years, they have given between 13 to 17% returns over this period. Now, while this is not guaranteed, and you have to be very clear, this is not a guaranteed return plan. None of these are guaranteed return plans. Over a period of time, they should give you similar returns. They should give you pretty decent returns. Their cost of operation is between 1 to 1.5%. That is lower than most mutual funds. So most equity mutual funds will operate at between 2 to 2.5%. So the cost of these ULIPs is actually lower than mutual funds, and you are getting the term insurance cover also. So low-cost ULIPs are a great way to invest. I think IMAX is returning, from whatever I understand from my conversation with the company, IMAX will return in the next month or two. And I think these are good products. The returns that you've been mentioned, so you were investing 25,000 rupees for a period of 11 years, so that means you've invested about 2.5 lakh rupees. Those going to about 4 times over a period of 11, 12 years is not a very tough ask. It does happen in the market. So let me put it very simply for you. 2003, our stock market is 3,000. It's at 25,000. It's 8 times. So if you take away 1 or 2%, it still gave you a pretty good return. So the stock
but of course, the caveat is it depends upon market conditions and the stock market.
Absolutely. However, let's take the worst possible condition. 2008 is when it went down to its lowest possible, which was about 8,000 rupees. But still, from 3,000 rupees, it gone to 8,000 rupees, which was about 2.5 times over a period of time. Now, of course, all these things, you cannot say that every year you will get that return. So you've got to be patient in a ULIP. You cannot say, 1 year is over and my returns are not there.
So it's a long-term perspective
15,
that the
20,
consumer
30
needs
year
to take.
bet.
Right.
And you will get the good return then.
Right, Yashish, we've got Kontia Sinha from Delhi, and he says, I want to buy a Mediclaim policy for me and my wife. Ages are 28 and 24. Please help me with the insurance company. Which insurance Mediclaim should I buy? He wants a coverage of up to 2 lakhs and his monthly income is 15,000 rupees. Yashish.
So I think there are lots of options for him. I would suggest any of the government companies. He's got the option of Oriental. He's got the option of New India, option of National. In addition to that, many of the health insurance specialists have got specialized plans. But at 2 lakh rupees, most of them will have a co-payment or some kind of sublimits and caps. All the government companies also have sublimits and caps. So at a 2 lakh coverage, please understand it's not a 2 lakh coverage as in you stay in hospital for 4 days, it costs 5,000 rupees per day in hospital, and hence you get 20,000 rupees. No, it doesn't work that way. You would have a room rent capping of maybe 2,000 rupees or 3,000 rupees. And so you would only get up to the 3,000 rupees, and all the costs associated with that would also be similar. So yes, there'll be certain restrictions at the 2 lakh rupee point. But all the health insurance specialists, Star Health, your Apollo, Max, Cigna, all of them do have their plans, plus Religare Health. You also have the general insurance companies, so ICICI, HDFC, Tata, Reliance, L&T Health Insurance. So you've got quite a few options out there. I would suggest, look, if you are looking to buy this in a serious manner, please go through a detailed research, go through all the options, and you will come up with fairly robust answers for yourself, because it'll depend. Do you want a pregnancy cover? Do you want a child cover?
Right.
Or do you not want a child cover? You would need quite a few options here.
Right, so lots of options for the consumer there. We've got Deb Chatterjee from Kolkata, and he says, I'm a retired SBI official. He's 61 years old, and he says, as per a scheme of our bank, we pay 62,000 to the bank at the time of retirement for medical reimbursements are made up to 7 lakhs for the family and the self, of course, during the remaining period of life for both. Now, he says, I've joined the scheme. Please advise me if I need a further medical insurance.
So the answer is absolutely yes, you need further medical insurance. So please appreciate that when you take a medical insurance plan, the medical insurance plan is not the 3 lakh rupees per year that you take. Suppose your remaining life of your entire family is, let's say, 30, 40 years. If you're 60, you may live up to 90. Many people do. In that case, it covers for every year of that period. So suppose you take a 5 lakh rupee plan, it is probably equal to about 1.5 crore. So the 7 lakh rupees will get consumed very quickly if any serious illness happens. And see, today, hopefully you're hale and hearty and you don't feel the need of such costs. But if any disease hits, then the costs start piling up every year, and they just come year after year. So at that point, nobody's going to give you health cover. So please take health cover if you're still fit enough to take it. This plan is good. You're spending 62,000 rupees, and it's giving you up to a cover of 7 lakhs. It's specifically designed for your bank. That's good, but it's not adequate as a health insurance cover. So please do take a separate health insurance cover as you can afford best.
Right, Yashish. Thanks a lot for that wonderful advice. But that's all the time that we have on this show of Policy Bazaar. But do write to us at ask.policybazaar.com or tweet us at Twitter at policybazaar_in. And we'll see you next time with another episode of Policy Bazaar. Goodbye.